We also leveraged inorganic opportunities, having completed nearly 5 M&A transactions in the last 3 years. During FY26, the company undertook a cumulative capital expenditure of over 750 crores, representing more than 60% of the opening gross block at the beginning of the year. Importantly, this growth was guided by our capital allocation discipline, with all projects evaluated against our internal return thresholds. We maintained financial discipline both from the perspective of the balance sheet in terms of the overall debt and also from the P&L perspective in terms of the overall return on capital employed. The performance of the company in the third quarter and for the 9 months ended FY26 reflects this consistent and disciplined execution of strategy to build a diversified and scalable manufacturing platform. This execution translated into our highest ever quarterly financial performance, with the company delivering an EBITDA of 93 crores and a PAT of 36 crores, even after accounting for a one-time provisioning impact related to the new labor code. As this capacity starts ramping up from Q4 FY26 and onwards, it will provide strong foundation for the next phase of our growth. We enter this new phase with optimism led by the macroeconomic tailwinds like reduction in the GST rates and the recently announced trade deals with the EU and the US. In order to ensure that we are able to leverage all the opportunities available to us, we are strengthening our organizational structure and building our senior management team with the addition of business heads for various verticals. As the first project of this new phase, the board has authorized a greenfield HPC home and personal care project with an investment of 50 crores. In summary, we will close FY26 with a strong manufacturing platform, improving utilization, clear execution visibility, and we will enter FY27 with the same financial discipline, giving us the confidence of delivering on the guidance that we have outlined in our investor presentation. I will now hand over the call to Ganesh Argekar, our Executive Director, to brief you on the operational highlights.
Thank you, Samir, and good morning, everyone. While Samir and I talk about financial discipline, I will take this opportunity to highlight the operational discipline and excellence in execution that has been the foundation of the journey for the last few years. The last few years, and especially the last year, has been marked by excellent teamwork and execution by our project team, procurement, and supply chain team. The monetary value of 750 crores of capex doesn't do justice to the teams that have built more than 5 lakh square feet of space using thousands of tons of cement and steel, installed high-speed machines manufacturing beverages, ice creams, home care products, while doing so after getting necessary approvals from various regulatory authorities and ensure safe working conditions. I would like to emphasize that all projects have been completed on time and we have had no cost overruns in the last so many years. The third quarter of FY26 reflected this steady progress across our manufacturing network, with execution remaining firmly in line with planned timelines across both greenfield and brownfield projects. Operations across all our factories are stable, with multiple divisions like HPC and food and beverages delivering record production this quarter. Even the shoe division, which was a very complex operation, is now stable, and the various cost-saving initiatives are beginning to show results. Also, our ice cream division and the beverages division are now fully geared up for the upcoming season commencing Q4 FY26. Capacity enhancements at Mysuru and Lucknow have been commercialized and will ramp up from this quarter. New capacities at Nashik and Panipat are on track to deliver production for the season. All ongoing projects are on track. The brownfield detergent facility at Silvassa is targeting commercialization in Q1 FY27. The one for flavored yogurt at Goa will be ready by Q2 FY27, and the work on OTC Pharma project is also similarly on track. The new M&A at Aurangabad remains on track, and we expect to close transaction in this quarter. The new bottled water facility in the West is also advancing in line with timelines, with commercialization targeted for Q3 FY27. In parallel, preparatory work for the new HPC facility at Lucknow will now move forward following the board approval. Overall, the quarter reflects a continued strengthening of our operational foundation, with assets stabilizing well, capacities aligned to upcoming demand cycles, and team focused on disciplined execution. The operational readiness across categories positions us well to grow in the coming quarters on the back of tailwinds like the increase in volumes due to increased consumption growth, and also possibility of export stabilizing with the signing of new trade agreements. With this, I will now hand over the call to Mayank Samdani, our Group CFO, to take you through the financial results for the quarter and 9 months ended 31st December 2025. Thank you.
Thank you, Ganesh, and good morning, everybody. I would now run you through the financial performance for Q3 and 9-month FY26. For the 9-month ended December FY26, total income stood at 3041 crore, representing a 15% year-on-year growth. EBITDA has increased 17% year-on-year to 266 crores, reflecting sustained operational efficiency across businesses. Profit before tax grew 31% to 140 crore, while profit after tax increased 31% to 103 crores. Turning to third quarter, the total income grew 13% year-on-year to 1,000 crores. EBITDA increased 18% to 93 crores, marking the highest ever quarterly EBITDA of the company. Profit before tax rose 29% to 51 crores, and profit after tax increased to 26% to 36 crores, even after accounting for the one-time provisioning impact related to the implementation of new labor code. Over the past years, Hindustan Foods has expanded meaningfully through meaningful organic investment, complemented by our string of pearls acquisition strategy, which has enabled faster capability building and entry into adjacent categories while shortening learning curves. Despite this elevated investment phase, financial discipline remains central to our capital allocation framework. All new projects are evaluated against the internal minimum return threshold of 18% ROCE. As of December 2025, the annualized adjusted ROCE stood at a healthy 19% after adjusting the capital employed with CWIP and assets which are not ramped up or underutilized. This underscores sustainability of returns even during the capacity creation. On the balance sheet, our position remains strong. As of December 31st, 2025, cash and cash equivalents stood at 151 crores, and the net debt to equity was at a comfortable level of 0.77x, well within our internal comfort threshold. CapEx continues to be funded through the prudent mix of internal accrual, debt, and preferential equity issuance, while maintaining the balance sheet resilience. The recent changes in the GST framework have led to renewed optimism in the sectors that we are in. We are optimistic that the reduction of GST in categories like bottled water, ice cream, and foods, etc., will lead to the meaningful increase in the consumption and create new demand for the capacities. However, this reduction is also leading to some unforeseen effect to our business. In some of these categories, we are seeing a duty inversion, which will lead to an increase in the company working capital requirement. To mitigate this, the company is discussing with certain customers to transition commercial models to one where they will supply raw material and packing material on a conversion-based business model. If implemented in select cases, revenue occurring to the company would be only to the extent of the conversion cost as opposed to the cost of the entire finished goods. Thus, though there will be no change in the company absolute profitability, however, reported margin may appear optically higher, as revenues appear to be lower due to this change in the revenue accrual. These discussions are currently ongoing, and the company will share further details as and when there are the material developments. Turning now to our outlook of FY27, our confidence is grounded in the structural progress made over the past several years. From FY21 to 26, the company has delivered a steady and consistent increase in profitability, with profit after tax rising from 34 crores in FY21 to an estimated of 140 to 145 crores in FY26. This trajectory reflects disciplined capital deployment, diversification across categories, and a gradual stabilization of new capacities. For FY27, we are guiding a profit after tax range of 200 to 220 crores, representing approximately 1.4x growth over FY26 expected. This guidance is not driven by a step change in assumptions, but by the progressive ramp-up and normalization of assets that are already commissioned or nearing commissioning, along with the continued operating leverage benefits. We also expect the earning profile of FY27 to remain balanced, with H1 contributing approximately 43 to 48% of full year profit and H2 contributing to remaining for 52 to 57%, broadly in line with our historical seasonality across certain categories, while maintaining overall earning stability. In summary, the quarter and the 9-month performance demonstrate the resilience of our manufacturing-led model, the effectiveness of our execution, and the continued focus on balancing growth with returns and balance sheet strength. With this, I would like to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Faisal from HG Hawa. Please proceed.
Hello. Hello.
Yeah, Faisal, we can hear you.
Samir, can you give some light on how the shoe business is moving, and also do we see more outsourcing of production from large majors like shopping chains, etc., from the US to us, and we could get into many more verticals of manufacturing itself, having almost now perfected ourselves in so many different verticals?
So, Faisal, like Ganesh mentioned in his opening remarks, the shoe business was very complex. It took us some time to understand the entire supply chain, etc. But I am reasonably pleased with the performance of the shoe business now. We've understood the business. We've managed to understand where the costs are and how the costs can be controlled. In terms of the future potential, the tariff, I think this will be the sector which will be most benefited by the trade agreements, both with the EU as well as the US. We are definitely very, very optimistic that the shoe business will be the one who will drive our export business. From an organization perspective, we have recently set up an international business division, and that international business division is headed by a gentleman who is quite experienced in international business. And hopefully in the next 6 months, we should start seeing him deliver some results on that. Your specific question about modern trade and organized retailers internationally looking at India as a sourcing hub for shoes is bang on. I think everyone is looking at diversifying their supply chain, especially after the entire upheaval in the last year or so. Now that the tariffs have been equalized, I think India as a country stands on a very good footing to be able to leverage this.
And are you taking some steps to make our organization more entrepreneurial also, and where we have many more sectors which will be like baby stage at this point of time, but could blow out, so that only a startup minded kind of a guy could seed in our organization?
So, Faisal, I'm hoping startup-minded is something that all of us are, in spite of the fact that all of us have passed the age where we should have been doing startups. I mean, the gentleman who's heading our international business is crossing 65. But on a serious note, Faisal, you know that we've taken 2 initiatives on that front. One is in pet recycling. We recently invested in a startup which is called the Kabadiwala. And we are very clear that pet recycling will be one of the sunrise sectors for us as far as the entire FMCG ecosystem is concerned, especially because we will be able to cross-sell a lot of these to our customers. and we are beginning to see some amount of traction in that division already. And I'm hoping that we should be able to capitalize on that. The other thing that we are working on is backward integration. You know that we recently acquired a cone manufacturing facility, as well as we set up a stick manufacturing facility for the ice cream business. I'm also, we are very keenly looking at what we're doing with beverages. I'm pleased to inform that at the end of this financial year, our total beverage capacity across the country will be more than 250,000 KL. That gives us a substantial amount of scale to be able to do other things, which would include backward integration, as well as, like I said, the PET recycling bit. So you're absolutely right. We continue to look at new ideas while we continue to scale in our existing business operations.
So we are committed that wherever some of the raw materials that we consume, if there is a very good opportunity, the scale as well as the ROI is there, we will go into backward integration also.
That's the plan. I think what we are committed to is manufacturing. I think we and Ganesh spent a lot of time in his opening remarks saying that our strength is that we are able to go across the country. We are now in 41 locations across the country. We are able to go across the country. We are able to acquire land across the country. We are able to hire teams. We are able to build factories. And that strength, I think we will continue to apply across product categories, whether it is in the existing categories or whether it is as a part of the backward integration, for sure. I think that's the strength that we are building on, and the scale that we are currently operating it at gives us the opportunity to be able to be a serious player even in the backward integration spaces.
And since we continuously require debt financing for new factories, is the company putting any thought to reducing this cost of financing for us, and whether it can be even reduced from here even more?
I'm going to let Mayank answer that, Faisal.
Yes.
Faisal, we are continuously trying to reduce our cost, but one thing you please appreciate that in our major part of the business, which is dedicated business, even our interest is a pass-through cost. So any reduction in the interest cost is passed through to our customers also. So we are continuously in discussion with the bank with the to reduce our interest cost. You can see it in our financial performance also, where the quarterly numbers of the finance cost is not increased despite we have taken the extra loans.
Faisal, on that note, I just want to also quickly talk about the philosophy of the company. We will not be overly adventurous with debt. I mean, we take project funding. This project funding, Mayank discusses for specific projects, and all of them are collateralized against that particular project. But just in the quest of trying to get an arbitrage, we will not get experimental with new instruments of debt or foreign exchange denominated debt, etc. I think we will continue to be conservative, even if it is at the expense of certain bits in the short run.
Thank you very much. I appreciate answering my question so well.
Thank you, Faisal.
Thank you. We take the next question from the line of Kashyap Zaveri from MK Investment Managers. Please proceed.
Yeah. Hi. Thank you very much for the opportunity, and congratulations on great set of numbers. Two questions from my side. One is on our guidance for FY27 in terms of profit. Now we will be capitalizing about 780 crores of gross block this year. But if you look at profit growth next year, that's not sort of commensurate with the increase in the gross block number. So, the enduring benefits of that gross block would also continue through 2028. That's the first question. And second is a question on our investments in the F&B part of the business, where this year we are investing only just about 30 crores. But if I look at our press release, recently we have inducted a gentleman from experience in Unilever, particularly within Lipton teas. So does that mean that if I look at 27, 28, there will be accelerated investments also in F&B part of the business, ex ice cream?
So Kashyap, hi. So two questions. One is, will the growth in profitability be reflected beyond FY27? The answer is definitely yes. I think what we've done, along with all of our CapExes, we've also mentioned when they will get commercialized. When Ganesh was talking about his opening remarks, you would have noticed that some of them are getting commercialized in Q1, Q2 of next financial year, even as far as Q3. So obviously, some of this will come in 27, 28, and the ramp up will show up there. The number that we've given a guidance for obviously is only for FY27. We've not given any kind of guide for FY28, which we hope should be better than FY27 anyway. You'll also note that even in terms of CapEx, we've already given some announcement about that the CapEx journey will continue in FY27 as well. So obviously, the CapEx which is being announced, which is in the new HPC segment, will start reflecting only in FY28. So that's something of an ongoing process, and you're absolutely right that the 750 crores will take some amount of time to reflect completely, and that will be between 27 and 28. Now, coming to F&B, I'm not sure that our investments have been low. I think the sector is such that the capex intensity as compared to ice creams is very, very different. We have made some announcements already in terms of our flavored yogurt brand, as well as OTC/nutritional product in terms of foods and beverages. You're absolutely right in identifying that there's a senior member who has joined our senior management team, and we are quite bullish about food and beverages. I spoke about beverages when I was answering Setal's question as well, that we will now be making about 250,000 KL of beverages across our factories. And we are reasonably bullish that we should be able to expand capacity further in that segment. So in terms of focus, yes, we will continue to focus across all 5 BUs. So I'm not being partial to any one of them. We will continue to expand. There have been developments across all the sectors, even in ice creams. Recently, we've acquired a cone manufacturing facility, plus we've signed up a couple of new customers. We are hoping that by FY27, etc., we should be able to allocate capital further to ice creams as well.
So sorry, but to just sort of having a slightly longer discussion here, particularly in F&B, I'm not just looking at it compared with other businesses, but if I look at it's on its own strength, from about 230 crores of gross profit in 2024 to roughly about 330 crores in 2026. The increase, is also on its own significantly lower. Though I understand that asset terms may be large, but the growth in the gross block is much slower than any other. That's where I was coming from. So I'm not saying that will it be the focal point. All I'm asking is that would that be now seeing as much accelerated growth as in gross block as other businesses?
Kashyap, maybe I didn't communicate this well. Let me start all over again. So each of our segments have a different asset intensity in terms of asset turnovers. So you will see some businesses which require a lot more investment in capex for us to be able to grow, and some of them may not. Since you're picking on F&B, let me be a little bit more specific. I think Ganesh in his remarks mentioned last quarter and maybe this quarter as well that we've increased our capacity in our Mysore factory by nearly 100%. That's a tremendous increase in terms of capacity. However, it may not reflect in terms of capex because we had the existing land. We had an existing land there already. We invested in 300 bottles per minute line, which increased our capacity from 150 to 300, which may not translate into the same amount of asset turns. So when you look at the only reason the question probably is that do we focus or do we continue to invest in F&B? The answer is very much yes. Will we invest, let's say, 400 crores like we've done in ice creams in F&B? The answer is probably no, because in case we have to invest 400 crores in F&B, the size of the project and the total capacity that we would have created would be much larger than what we think we can sell.
Understood. That's perfect explanation. Last, just on the debt side, quite commendably, I think net debt now gets limited to the same number as probably the previous quarter, despite the growth. At some point of time, let's say 24 months down the line, would we see that absolute number also declining? Is that a possibility?
I am nodding my head and asking Mayank to answer that. So let him answer this.
So, Kashyap, though you are correct in that some of the loans will get repaid, but at the same time, because of the new capex, which, as Sami told you, this is a continuing process where we will continue to invest in the capex, and with the judicial mix of debt and equity, our internal target is 1:1. So we don't see debt coming down drastically in coming years, since we are investing in the new capex altogether. But we will make sure that it will be the judicial mix of equity and debt in that.
Sure. So thank you so much for the.
Wait, no, we're not done. Yeah, we're not done. This is a question which I need to spend some time on. So, this is more a philosophical question, right? And the philosophical question is, will we continue to grow? The answer is very much yes. I think the idea of putting out the capex beyond FY26 was that the journey will continue. It's not the end of it. We're not taking a pause. And if we're going to continue investing in capex, will we continue levering it up? The answer is that given our business model and given the kind of counterparties that we work with, and given now the entire diversification which has happened across the company in terms of product categories, geographies, etc., we feel very comfortable that we should be able to service this kind of debt easily. So will we continue to take on debt? The answer again is very much yes. I think I can go out on a limb and say that if you just look at our operating cash flows, and if you look at levering it up 1:1 like Mayank said, we should be able to grow at about 20% per year, just on the basis of that. I think in the opening remarks, Ganesh talked about the amount of effort that goes into when we are executing these kind of projects, etc. And I think that will continue. So 20% growth is definitely what we are aiming for. To be able to grow at 20%, we will definitely need the 1:1 debt. We are comfortable taking that project debt. We are not comfortable trying to be maverick in terms of trying out new debt instruments or stuff like that. We will stick to the traditional project loans. And even if it, like I said in the earlier question, even if it is at the expense of a few basis points of interest rates, that's what we'll continue doing. So I think I do not see a situation where the net debt or the debt levels will decrease. At some point of time, if we stop investing, that's another story, in which case we will start returning money back to the shareholders by way of dividends.
Okay. And again, fantastic set of numbers. Congratulations and best of luck for future. I must also sort of commend, Mayank's team for the detailed disclosures and the way they have been presented in the PPT. Thank you so much.
Thank you very much, Kashyap.
And a small credit of this goes to Brinkle as well, who's part of the SGA team.
Absolutely. Thank you.
Thank you. We take the next question from the line of Aegis Lakhani from Unifi AMC. Please proceed.
Hello. Am I audible?
Yes, you are.
Perfect. So firstly, team, thanks for the chance and congratulations on good numbers. So I have three questions. Question number one is that in your opening remark, you spoke about the duty inversion leading to a higher working capital requirement. Could you outline some more color on the same? So what parts of the business models are affected, which segments, how much percentage of the business, some incrementally more color on the same? How do you see that getting implemented through the year, etc.?
So it is as in my opening remarks, I just mind here, in my opening remarks, I have underlined that bottled water, ice cream and foods where the duty is cut down in last September or October opening. We are evaluating this right now, and it is too early to give some color, but these will be the sectors where the duty inversion has started, and it will continue to start till we do something on it. Just to give you an example, ice cream has come down from 18% to 5%, right? And the components which comes in is basically coming at the same rate which they were earlier. So there is a obvious mismatch between the outgoing GST and incoming GST. So this is what I was referring to in my opening remark, and it is too early to say because this is just a quarter, it is just started. But this is to give you some idea that this will happen in a process, and it will continue to happen in coming years.
So could you call out how much percentage of the business will see this repivot?
So this is Samir again. This is difficult right now because we obviously discussions with customers have just begun. And none of the customers are going to agree so easily. There's going to be changing in terms of accounting processes, procurement processes, etc. What we are trying to do is just trying to sound you guys off, saying that while we are very bullish and optimistic about the GST reduction, it also has a second order effect which is leading to duty inversion in case of some of our products. This duty inversion needs to be addressed. Like we've mentioned a bunch of times, we are reasonably disciplined in terms of our working capital investments, and we definitely do not want to be in a situation where we are investing money in GST. However, the main point that Mayank wanted to bring out, and I'm going to just repeat it on his behalf, is that whatever agreement we come out with the customer, this will be more of an accounting thing rather than actually a material effect on the profitability of the company. The profitability of the company will remain the same. However, the revenues will probably change and the recognition of revenues will change, in which case, frankly, the margins will appear very good, and some of you might actually pat us on our back saying that the margins have improved, though it will just be an optical improvement, and the fact of the matter is we'll make the same amount of money that we were making earlier.
No, point taken and understood. I was just trying to understand that if there is a quantification on the revenue side so that, we could understand it better, but point taken. My second question is around ice creams. So from the 3 facilities that you are building out, Lucknow and Nashik, you've mentioned is fully, ready for the upcoming season. But the question is on Panipat. So you have called out in the PPT on page number 9 that you expect production to begin in the first quarter 27. So my question here is that given that you would start in the first quarter, the initial inventory requirement and stock up that will be required from the Panipat facility, is it fair to say that we may miss some part of the season in the stock up, and or do we expect the Panipat season to materially contribute to this year's segmental ramp up as well?
So in terms of the guidance that we have given both for this year as well as for the next year, we obviously have taken that into consideration. It would be foolish of us to mention that on page number 9 and give the guidance on whatever page we have without considering that, Aegis. So we are well seized of the fact that this ramp up of the assets will happen predominantly in FY28. That was one of the FY28. That was one of the reasons why when replying to one of the earlier questions, we said that even the FY27 number that we've given will improve in FY28 as well. Now, so are you asking about the profitability or are you also asking about the working capital?
No. So I just wanted to understand on the profitability and working capital associated with Panipat versus Lucknow and Nashik.
In fact, Panipat is one of the first sites where the discussions about this GST change Mayank has already initiated with the customer, saying that we would much rather shift the commercial relationship into a situation where we are billing only for conversion costs rather than buying the raw material and packing material ourselves. In which case, in the month of March, while we will stock up on raw material and packing material, it may not show up on our books and will show up on our customers' books.
Understood.
That's as far as working capital is concerned.
No, understood. It's clear. And lastly, could you just throw some, if it's possible, some, I know you do not prefer to, but any matrices around shoes and ice cream? What are we from a run rate perspective at? Where are we from an EBITDA standpoint? Where are we from an ROC standpoint for the businesses as a cluster for how we're exiting 26 and how you incrementally believe 27 will shape up?
So we prefer not doing it segment-wise, and frankly, we did that at a company-wide level, saying that very clearly that our goal is to be between 18 and 20% ROC as a company as a whole. Like I said, some of these segments will have higher number, some of them will have lower number. Could be because of the asset turns, could be because of the capex involved, could be because of the nature of the business, where some of them are predominantly shared manufacturing versus dedicated manufacturing. And one of the reasons why we don't want to get into segment-wise details is because obviously it leads to competitive information being sent out in the public. But company as a whole, the idea is to go for 18 to 20, and we took some pains in trying to demonstrate that that's where we've been historically as well, if you exclude the capital work in progress.
Noted. Thanks and all the best. And it's a very difficult business, so credit to you and the team for being very disciplined and execution focused. Thanks.
Thank you.
Thank you. We take the next question from the line of Akhil Parekh from 360 ONE Capital. Please proceed.
Hi, thanks for the opportunity and congratulations to the entire team for a good show. Good and consistent show rather. So my first question is on the debt part, right? I mean, will you be able to guide like absolute debt wise how it should look like say in FY 27 and 28? Ideally, won't the debt to equity should be declining from where we are at current level, given the operating cash flows which we will be generating over FY 26 to 28? That's my first question. And hence the ROC, pre-tax ROC should go back to 20% somewhere between 27 and 28.
So, Akhil, that would depend completely on whether we are continuing our investment journey or not, right? And we are hoping to be able to continue our investment journey. So, which is why we said that if the OCF is levered up 1:1, that gives us enough cash flows to be able to continue growing this business at 20%. And we are hoping that we will be able to leverage that opportunity for sure. In terms of a regular project which has stabilized, you are absolutely right that that would get paid off. But for the company as a whole, especially because of the tailwinds of the GST cut, etc., we are a little, let's say, optimistic that we should be able to sign up more projects which will ensure that 20% growth. So frankly, we are hoping that we won't be in a situation where we'll be paying off debt and not taking on more debt.
No, I'm not saying paying off debt, but it can remain at this level because our operating cash flow should be good enough for us to grow for next 1.5 years, right? I mean, if I look at our EBITDA, absolute EBITDA number, cumulative should be closer to around 800 crore for 26 and 27. And our operating cash flow can be a 50% of that, so around 400 crore of operating cash flow over 26 and 27. Is that a right assumption? And if that is the case, ideally we should be, ideally the debt to equity should decline, right? Assuming the debt will remain stable at current level.
So again, depends completely on the opportunities that we get in terms of new projects. If we do not get enough opportunities, it will obviously, what you're seeing will happen. I am a little bit maybe more optimistic than you are, especially because of the changes in GST and a little bit of optimistic commentary coming in from all our clients, that I think we should have enough projects going into FY27 and then into 28.
Okay, sure. And would mind be able to guide absolute operating cash flows for 9 months?
I will reluctant to give this time because cash flow, because this is not the balance sheet quarter. So there are many adjustments in the cash flow which needs to be done. I'm little reluctant to give this number right now.
Okay, but end of year, like last quarter, Samir had guided for 200 CR plus of OCF. Would that be a fair assumption?
Full year basis, yes, that is a fair assumption to make here.
I think in the first half.
In first half, we have done around 120 crores. Second half can be better than that. Would be better than that.
Sure. And my second and last question on the, I know Samir is kind of alluded to the previous participant's question that category-wise we are not giving any guidance. But I'm sure internally there would have been some discussion, right, of the 220 crore PAT which we are assuming 200 to 20 crore. What is the rough estimate we should expect from dedicated versus shared? If that number, if you can kind of provide, that would be helpful, basically.
So dedicated versus shared, we've given us a presentation by slide which gives the breakup of our revenues, EBITDA, as well as the gross block. While it's obviously not being broken down to the PAT level for the reasons that there's a lot of allocations and amortizations across the categories, I don't think we'll be able to give any more granular detail beyond that, Akhil.
Okay. But on sports show, last quarter we had highlighted 135 crore is a quarterly run rate. Is that run rate going to continue for this remainder of the 26? And should we see a better growth on 27, assuming export sales don't kick in 27, just on the purely domestic business in sports show? We can see somewhere closer to maybe 600-650 crore of sales level for sports show, and I think 5% of PAT margin is what probably I think in one of the phone calls you have mentioned. Would that be a rough ballpark estimate?
So again, without getting into the specifics of each segment, the guidance that we've given for FY27 includes what our internal targets are for each of those specific business units. In terms of shoes, I just want to highlight one thing that the macroeconomic conditions have become better. I think the clarity on both the EU and the US trade treaties makes a big difference in terms of my pessimism 3 quarters ago has now changed over to optimism from that perspective. So we are quite confident about the shoe business, but confidence will take 6 to 8 months to translate into action because this is a fashion industry. From that perspective, any kind of supply chain changes that even international customers or international retailers need to make, the lead time or the gestation period would be at least 8 months to a year. Are we confident about it? Yes. Are we putting our money where our mouth is? Absolutely. Like I said, we've hired people to go after that kind of business. And as a company, we feel quite comfortable that the shoe business, we now understand and we are able to run it well.
So to sum it up, there are no internal challenges basically in the sports show, and if the demand kind of accelerates, then we should see a better growth rate basically in the sports show. So from our side, there are no challenges in this business.
Absolutely.
Great. And just last, if I can squeeze in on the health and wellness segment, if you can give more color of what is happening on the OTC part. And in the shows business as well, I have not heard on that part of the business lately. And health and the OTC, but the client was 150 crore of acquisition which we had done. And we kind of maintain 3x kind of asset turn in this overall basically. And I know things have changed in the last 1 or 2 years, but if you can throw more light on this OTC business and how it would look like basically in the next 1 or 2 years. Yeah, that's all from my side.
So again, Akhil, without getting into the specific numbers segment-wise, OTC pharma business will probably be the second business which will be favorably affected by the clarity on EU and US tariffs. We had made an announcement a couple of quarters ago that we had already been approved and signed up. We had signed up with a customer based in the US. Because of the uncertainty around tariffs for the last 6 months, that project was going a little slow. However, based on the recent developments, we believe that should get accelerated right away. Also, in terms of the OTC pharma export business, we've recently strengthened our team from that perspective as well. We are going after some of the export OTC business, whether it's a Dr. Scholl kind of products or other products, we are looking at how we can do that. Unfortunately, for both the segments, the shoes as well as OTC pharma, the lead time for export and international business is quite high. In case of shoes, because of the fashion, and in case of OTC pharma, because of regulatory requirements. So give us about 6 to 8 months, and I think in 6 to 8 months, we should definitely come back with some interesting stuff on the export front.
Sure. But incrementally, the ROC would be better, right, in some of these projects, like the US-based client you mentioned?
Especially in case of OTC, it will be an incremental ROC accretive business anyways, because any more business may not require any additional capex. I'm talking about the export business. We are already announced one capex in Baddi, where we are starting to manufacture some Ayurvedic wellness products. That is well underway, and that will start production in the middle of next year anyways.
Great. Thanks a lot for detailed answers and best wishes.
Thank you, Akhil.
Thank you. We take the next question from the line of Nitin from Green Capital Single Family Office. Please proceed.
Hi, good afternoon, Samir, and to the management. This is Nitin Shakta from the Green Capital Single Family Office. So my question pertains more specifically to the foods manufacturing business. Just wanted to get a sense of if entrepreneurs in India are approaching Hindustan Foods for a lot of more contract manufacturing in different categories of the foods business, mostly like perishable or non-perishable products. And also conversely, are also food brands which are getting manufactured in Europe approaching our brand to contract manufacture? For the Indian market, just wanted to get a sense of how the movements are happening on contract manufacturing and subsequent distribution for food brands in India.
So Nitin, that's an interesting segment, right? So on one hand, foods requires or is amenable to a lot of experimentation, regionalization, small brands, etc. But as a manufacturer, we also hate the fact that it's amenable to small regionalizations and small runs. So while we are seeing a lot of small brands, D2C brands, innovative brands coming up with new product categories, etc., not all of them are attractive to us from a contract manufacturing perspective. And let me give you a specific example, right? So there's this whole host of D2C brands which have come up on the health platform, whether it is fresh products or whether it is low sugar products, etc. But for us, they would be material only when the minimum quantities or the quantities are viable from our factory perspective. Unfortunately, we are not in the food business where we are running or we are not optimized for running small kitchens or small batches. And as a result, we are more interested in large-scale food manufacturing. So maybe we are not the right people to comment on the extent of innovation. There's a lot of innovation happening in the food and beverages segment. However, we get involved only once that innovation has reached some kind of scale. So maybe we are not the right people to comment about that, Nitin.
Okay, so just wanted to, I've understood that. Thanks for clarifying that in terms of the volume. So also, are any large food manufacturers from outside who want to contract manufacture in bulk from India? And they could be famous brands who want to set up a manufacturing base but don't want to set up a manufacturing plant would that be a potential client for an Hindustan Foods if they give the volume? Obviously, it depends on the category and which brand. But
Absolutely. But again, has got to do with the volume. I mean, and I don't want to name names, but even biscuits and ice creams were getting imported till a few years ago because the scale of the business was not that large. There are certain biscuits which were still getting imported and just recently started getting manufactured in India. So once India is a large country, but it also, in terms of foods, achieving scale is not that easy because of the same problems that I mentioned earlier, regionalization, taste variations, etc. Once any brand achieves a reasonable amount of scale, that's when we would come in. And that's continuing, or that's going to be the way ahead as well. I don't see ourselves being able to provide solutions for very, very small volumes.
okay, great. Thanks a lot. And I'm also assuming that scale is also a function of, let's say, the brand gets a lot more distributorship, and then the demand for the product builds up in the country. So it's a corollary factor of the distribution getting built and then the volume order coming to the contract manufacturer like yourself.
Absolutely, Nitin. And which is why I mentioned that certain variants of ice creams, certain variants of cookies, biscuits, continue to get imported into the country till they reach some kind of scale. And the moment they reach some kind of scale, the brand owners then decided to indigenize it. You'll be surprised to know that even chips and pet food were being imported into India, brands which most of the people would be very familiar with, but unfortunately the scale wasn't enough to justify setting up a factory in the country.
Okay, great. Thank you, Samir, and all the best for the future.
Thank you, Nitin.
Thank you. We take the next question from the line of Abhishek Mathur from Systematics. Please proceed.
Yeah. Hi, Samir and Mayank. Thanks for the opportunity. So firstly, just wanted to check on the gross block bit. We have announced 60-80 crores at the end of the quarter, and we have talked about 2,000 crores by the end of the FY. For FY27, what kind of a number are you looking at? So you talked about a 50 crore HPC project for FY27, and you have gone ahead and given a PAT guidance for FY27 also. So on gross block, what kind of a number? And on FY28, any initial feelers if you can give me?
Abhishek, the general practice and the policy of the company is that we make announcements of capex only after the contract has been signed. And as a result, the only announcement that we've made for FY27 is the one where we have certainty in terms of that investment. We generally do not give guidance in terms of our projects based on the pipeline, etc. And which is why I think we took some pains in that graphic of FY27 so that people don't mistake that the only investment we are going to make in FY27 is 50 crores. That's not the case. What we are saying is that we will make the first investment which has been signed for FY27 is that 50 crores. We continue to work on a bunch of leads as and when when we get the green light on that, we will come back to you. I do not have enough granular detail to be able to give you a guidance in terms of what we want. It goes back a little to Akhil's question where we said that we are optimistic. We believe that we should be able to continue the pace of capex just the way we've been doing. However, if things don't materialize, we will obviously come back to you, and it will reflect in the fact that the net debt, like Akhil was saying, will start coming down.
All right, Samir. Just a clarification on slide number 13 of the presentation where you've shown the adjusted net capital employed. So there is a line on the to be commissioned and the underutilized assets with the values there. Is this understanding, so if I deduct the CWIP for FY24-25 from those numbers mentioned there, I will get to the assets that you have taken out because those are newly commissioned and yet to achieve optimal utilization. Is that understanding correct?
You are talking about the CWIP in the balance sheet?
Yeah.
So that those are the assets which is not commercialized still. We are talking about both, which is in CWIP stage and commercialized but not ramped up or underutilized. These are the total of all these assets. and also the capital advances where we have paid for the capital advance and still the either equipment has not come, bills are not booked, and these are not gone to CWP still. So this is the total of all things which is either not capitalized or not ramped up and underutilized.
So,
for example,
sorry, let me just explain the thinking behind that slide. The thinking behind that slide was to try and delineate our business model in a way that, one, our internal parameters for all projects is clear, which is that we will not take on projects which are less than a minimum threshold of about 18% ROCE. However, there was a disconnect, and a lot of investors and shareholders came back to us saying that while you say this, the fact of the matter is you're delivering about 14-15% of ROCE. So I think Mayank and the SGA team worked on trying to address this concern. And the way we wanted to address this concern is that given that we continue to invest in CapEx, in any given year, we will have certain capital work in progress that will obviously get captured in the balance sheet, but we will also have certain projects which might get commercialized from an accounting perspective in a particular financial year, but may not deliver their normalized earning capacity in that financial year. Let me give you a specific example. So if you look at the Panipat project, for instance, the Panipat project we are hoping will get commercialized by Q1 of FY27. However, that entire asset is going to be carried through the books in FY26. And in FY27, given the seasonality of the business, it will ramp up to its full capacity or full utilization or normalized earning capacity only in FY28. Because if you look at April, May and June, we will still be ramping up that asset. And it will reach its, I mean, hopefully all the factory machines, etc., start working properly by June, July, August, by which time the season would have wound down, which means the actual earnings of that site will start in FY28 season, which will start from Q4 of CY28 season, which is Q4 of FY27 and Q1 of FY28. So what Mayank and the SGA team have done, they have tried to address this, reduce that from our gross block. Obviously, they've used a kind of a thumb rule in terms of identifying those assets, etc. That's what we're doing.
No, fair point, Sabir. I get the logic behind this adjustment. Seems fair. Just wanted to get a sense of the 405 crores which is mentioned at the end of December 25 in terms of the to be commissioned and the underutilized. Possible to get a breakup of how much is to be commissioned and how much is underutilized out of that 405 crores?
Yes, Abhishek, just give me a second. Mayank is giving you the numbers.
Sure.
So around 200 odd crores is under yet to be ramped up or underutilized, and the rest is capital WIP and the capital advances.
All right, thanks a lot for that, and that's it from me. All the best. Thanks.
Thank you. We take the next question from the line of Mayur from Wealth Managers India Private Limited. Please proceed.
Good afternoon to the team, and congratulations on delivering decent set of numbers. The reason I'll say decent is it was long overdue and it has come. So congratulations on delivering that. I have a couple of observations and also questions. One is, finally the bug has beaten us to give a guidance on the profit numbers. This was not what we had seen earlier from you. I hope when we give a disclosure like this, it is relatively consistent, not only the profit guidance, but the disclosures which we have. I understand that one may want to stabilize these numbers and the disclosure part, but the consistency even on disclosure will be important. It's like an expectation. You have taken us to an expectation of a certain profit guidance and a certain ROC guidance. I hope the disclosure continues to maintain this so that we are able to evaluate the business on an ongoing basis. That will be very helpful. So that's just a suggestion that hope this consistency is maintained as we go ahead over the quarters. So that is one thing. The second part is on the again on the same previous question was more on the disclosure about the commission and will you be able to quantify or tell us what is underutilized? I understand qualitatively that remark which Samir you just mentioned about seasonality of products, but is there a way to understand for us in a more, will you say 50% utilization is underutilized? Will you say, how do we look at underutilized? Should we say 1 year before the commissioning is underutilized, so that it is easy for us to also track and understand how the ROCs are panning out rather than always coming back to you and trying to get a more qualitative understanding?
Sure, Mayur. So let's break that down, right? When we say underutilized, if for example the asset is underutilized because of our fault, meaning the management's fault, in terms of either not being able to run it properly or not getting enough orders, etc. Obviously, we are not going to try and reduce it from the denominator to artificially pump up the ROC numbers, right? So, for example, the shoe business, which has given us a lot of grief earlier, we obviously are not going to call it underutilized because of structural reasons. Underutilized for us would mean very clearly structural underutilization. Structural underutilization would refer to the timing of the asset coming on board. Let's say an asset comes on board post the season, like I just talked about Panipat, in which case it will continue to remain underutilized for a larger part of next year, in spite of the fact that it's been commercialized, right? And that would be underutilization. If let's say we had an ice cream factory and we did not have a customer for it, then that would be a problem. That obviously we would not call it as underutilized. The second thing is that in general, because we are talking of capex and we're talking of so many machines, etc., it takes us about 3 to 4 months to ramp up in terms of the overall capacity utilization. Now that's a structural part as well. Even if we are very good in our management, even then it would, or execution, it would still take us about 3 months to ramp up a factory of that size. That we would call underutilization, which is structural. We will not try and push our inefficiency under the pseudonym of underutilization.
Fine, I get this, and that's good to hear that. Okay, so let me try and understand this. Again, this is a question for Mayank, so that we are from a more numbers perspective. 400 odd crores is the number of underutilized versus or to be commissioned. We are saying 780 crores total gross block capex yet to in FY26, yes, to be there. Out of that, if I remember last quarter when the balance sheet disclosure was there, 200 of that was already commissioned. So we would have had around 500 odd crores yet to be commissioned anyways on that number. So will it be fair to say that underutilized stroke commission, that number as on FY26, just 1 day before commissioning would be around 700 crores, and that is that whole number will fall to the denominator, and then what happens to the ROC of 19%? Because we have already annualized the numerator, right? The numerator is already annualized 9 months. So we will not have a bump up on the numerator subject to actual versus annualized number. That's small difference. But the denominator meaningfully goes up because we are yet to commission a very large number of gross block, and the denominator and the ROC of even 19% does that. So I hope if Mayank gets that number, what I'm trying to understand, will the number be meaningfully different?
I requested Mayank to let me address the question. Both of us were fighting on who will answer your question. But Mayur, so let's understand this. The 9-month figure which has been annualized is at a run rate of Q1 plus Q2 plus Q3. If you look at the guidance that we've given for the year as a whole, we expect an acceleration of the number in Q4. We didn't want to break it up as a definitive number. Yes. So when you say that the numerator has already been captured, I think that's mathematically incorrect. Second, in terms of the 400 crore breakup, let me give you a specific example rather than Mayank can talk about the number as such. We recently invested in doubling our capacity in Mysuru, and the commercial production for that starts this week in time for the season. It will ramp up between February and March, and then the entire April, May, June, July, because it's in the south, we will be able to sweat that asset completely. Now, obviously, that asset will deliver its ROC as well as its numerator, as you put it, in this period. Will it be underutilized? It showed up as capital work in progress till, let's say, this week. Or this month, because it was not commercialized. Now it has been commercialized, but it will continue to be underutilized for at least a month or so, and then post that, so April onwards, it will ramp up. That's what we are trying to give you the color around. In terms of specific numbers, I don't know if Mayank wants to give any numbers.
So in case of the specific, we will have a separate discussion and we will give you the specifics, how we are breaking down it all. Yeah. Yeah, we don't have it handy as required by you, but overall thing, in the last question I told that around 200 crores is the asset which is capitalized and unutilized, and 200 crores odd is something which is still to be capitalized.
Okay. Last question from my side on the guidance part. You have mentioned approximately.
Mr. Mayur, due to time constraints, we would like to take that as the last question.
But you could have let me finish it at least.
Please go ahead, Mayur. Go ahead.
Yeah. Thank you for allowing and overriding this. Thank you. Just last question. Just understanding, on the guidance part, if you look at close to 200 to 220 crores of PAT guidance and FY26 more in the region of one, we are talking of overall roughly 50% kind of PAT growth in the next year, and that shows the momentum building on the operating leverage. I just wanted one small color on from your side is, we are currently looking at revenue growth in teens. And the quarter has also shown that due to operating leverage and other, the profit growth is more in the region of 30%. But next year we are talking of 50% kind of growth on the profit. Does it mean also that is it built on the significant ramp up on the revenue side also, or is it more similar in the lines of operating leverage only? And secondly, from an operation standpoint, is this number dependent significantly on the good seasonality of the ice cream business which is going to come? That's it. Thank you.
Okay, so Mayur, we've been steadfast about our suggestion to all people who follow the company that don't get obsessed with our revenue. I think Mayank in his opening remarks also told you about the GST. Just to recap that, our revenues are passed through in terms of any raw material and packing material cost. Our profitability is protected from that perspective, which is why we've given a guidance of the PAT and not of the revenues. In terms of the guidance and the increase, it actually goes back to your earlier question about the numerator and the acceleration of ROC. Like we discussed there, as some of these assets which will get commissioned or which are currently underutilized start getting ramped up in the next financial year, we will see an acceleration coming in sheerly because of the fact that these assets which have been invested have not been sweated completely in FY26, but will get sweated better in FY27. So a large part of that growth, the 40% of increase in profitability, is coming purely from that. I would urge you not to look at or ask us for guidance in terms of revenues. First, we avoided that anyways because it was a pass-through. Now with the complication of GST, we will frankly steer away from giving any guidance in terms of revenue.
Yeah, and on the ice cream side, if you can just clarify how much of it is dependent on a good season, because that's a seasonality. Last year also we saw some impact due to early rains and things like that. So how much of it is contingent on some of the seasonal products delivering?
So a large part of our business in ice creams is dedicated, which means that our profitability is not subject to the vagaries of the season. However, there could be a timing difference in terms of Q1, Q2, Q3, Q4, depending on how we perform, how the season performs. But at the end of the year, our number as far as ice creams is concerned is protected irrespective of whether it is a hot summer or a cold one.
Great to hear. Thank you so much and wish you all the best.
Thank you.
Thank you. Due to time constraints, we take that as the last question for the day, and I would now like to hand the conference over to the management for closing comments.
Thank you, Anushka. So before we conclude, I'd like to briefly touch upon an important area of focus for the company, sustainability and responsible operations, which remain integral to Hindustan Foods. As we continue to expand capacities and our geographical presence, sustainability is being embedded into project planning, energy sourcing, and operational decision making, ensuring that growth remains scalable and responsible. International business is one where, as Samir said, will be a focus area henceforth across categories. The macroeconomic conditions have certainly gotten better, and we hopefully next year this time HFL would have some international footprints to talk about. With a strong execution platform, disciplined capital allocation, and a clear focus on long-term value creation, we believe HFL is well positioned for its next phase of growth. Thank you once again for joining us today and for your continued trust in Hindustan Foods. And with Valentine's Day just around the corner, I thank you and wish to say, grow old along with us, the best is yet to be. Should you require any further information, please feel free to reach out to us or connect with Strategic Growth Advisors, our investor relations partners. Thank you again.
Thank you. On behalf of Hindustan Foods Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you, Anushka. Let me